Hello, everyone, and welcome. Today, we're going to tackle a concept that's so much more than just another accounting rule. We're talking about the accrual principle, which is really the bedrock of modern business decision-making. You see, understanding this is the key difference between knowing what's really going on inside a company and just, glancing at its bank balance. For any of you who want to be managers, analysts, or entrepreneurs, getting this down cold is absolutely essential. So let's start with a little thought experiment. Picture this. Your company works incredibly hard all through December to finish a huge project for a client. You deliver the final report on December 31st, and the client loves it. Great. Then in January, you send out the invoice. And finally, in February, the payment hits your bank account. So here's the big question. In which month did your company actually earn that money? Was it December when you did all the work? Was it January when you sent the bill? Or was it February when the cash finally showed up? Seriously, take a moment to think about it. Your answer really gets to the heart of how you view business performance. And that little puzzle right there, it highlights the fundamental challenge that accounting was basically invented to solve. In the real world, the timing of the actual work, the sales, the services, using up resources, almost never lines up perfectly with when the cash actually moves. This gap, this lag between doing the work and getting paid, can paint a really distorted picture of your business. I mean, if you only looked at your cash, December would look like a total bust for this project, right? Zero revenue. And February would look like a massive success, even though you didn't do any new work that month. How could any manager possibly make smart decisions based on information like that? Well, here's the solution, and it's actually quite elegant. The accrual principle. Now, this isn't some obscure rule. It is a cornerstone of both major accounting frameworks in the world. That's GAAP, or Generally Accepted Accounting Principles, which we use here in the US, and IFRS, the International Financial Reporting Standards used pretty much everywhere else. The whole point of this principle is to fix that timing problem we just talked about. It says we have to record business events when they happen, not just when the money changes hands. It's all about matching the activity to the right time period so we get an honest look at performance. So this is the more formal textbook definition. And the way we make this happen, the actual mechanism, is through something called adjusting entries. Think of these as special tweaks an accountant makes at the end of a period, like a month or a quarter. They go in and make these adjustments to make sure the financial statements reflect what really happened during that time. It's all about painting a true picture of reality, not just making a list of cash transactions. Okay, so let's break this down a bit further. We'll start with the revenue side of things. This part of the principle is often called the revenue recognition principle, and it's a huge deal in accrual accounting. It basically gives us the rules for when a company can officially look at its books and say, okay, we have earned this money. The most important word on this slide, the one I really want you to focus on, is earned. See, under accrual accounting, we recognize revenue when it's been earned. That means the company has done what it promised to do. It delivered the goods. It performed the service. In our consultant example, when was the service completed? December. So the revenue was earned in December. It doesn't matter that the bill went out later or that the cash came in even later than that. The work was done, so the revenue belongs in December. Period. Of course, making all that revenue isn't free, right? You have costs. So to get a true picture of how profitable you are, you have to look at the other side of the coin, your expenses. And the logic here, you'll see, is perfectly symmetrical. This side of the principle is often called the matching principle, and it's designed to work hand in hand with revenue recognition to give us that complete financial story. And for expenses, the key word is incurred. An expense is considered incurred the moment a business gets the benefit of a good or service, no matter when the bill is actually paid. For example, think about your employees. If they worked for you during the month of December, their salaries are a December expense. It doesn't matter if you run payroll and pay them on January 5th, you used their labor in December and you probably used it to help generate December's revenue. So the matching principle demands that we match those costs to the revenue they helped create in the very same period. Now look at this slide. What's so cool here is you can see that perfect symmetry in action. Both revenues and expenses are timed based on the business activity, not the flow of cash. On the revenue side, we've earned something. We now have a right to get cash in the future. On the expense side, we've used something up. We now have an obligation to pay cash in the future. Recognizing both of these at the right time is what allows us to create a meaningful income statement that actually tells us something about our profitability. Okay, theory is great, but let's make this real. Let's go back to our consulting project and walk through this step by step. Honestly, seeing the principle in action is the best way to make it click and to really appreciate how powerful it is for telling an accurate financial story. So here's our timeline again. 3 months, 3 very different events. In December,
The real value is created and delivered. The work gets done. In January, you've got an administrative task, sending the invoice. And in February, the financial transaction is settled. The cash comes in. Now, someone doing cash basis accounting would look at December and see absolutely nothing. But an accrual basis accountant, they see the single most important event of the entire project happening right there in December.
So, applying the principle is actually pretty straightforward. When was the service provided? December. That means the revenue must be recognized on the December financial statements. So, at the end of December, the accountant makes one of those adjusting entries we talked about. They'll record the revenue, and because they don't have the cash yet, they'll also record something called an account receivable. An account receivable is just a formal way of saying the company has a legal claim to that cash. It's an IOU from the client, and it's a valuable asset. So, you might be wondering, okay, Professor, I get it, but why go through all this trouble? Why have accountants developed this whole system? Well, it's because the whole point of financial reports isn't just to count cash. It's to give people, managers, investors, banks, you name it, a true and fair view of how the company is actually performing. It's all about making smarter decisions. And this is the absolute crucial point. Accrual accounting is designed to measure performance. It answers the question, for the month of December, did the value we created outweigh the resources we used up? Cash accounting answers a totally different and often misleading question. It just tells you if you brought in more cash than you paid out. Performance is about creating value, and that's what we need to measure. And right here, this is where the rubber meets the road. Think about it. Put on your manager hat. With accrual data, you look at December's report and say, wow, our team killed it this month. They generated a ton of revenue. That marketing campaign we ran last month must have worked. We should put more resources into that team and that campaign. But if you only had the cash report, you'd think December was a failure. You might even make a horrible decision, like cutting the marketing budget, or even worse, downsizing the very team that just had a fantastic month. You see? Accurate measurement leads directly to intelligent decisions. Now, this right here is probably the single most dangerous mistake that I see students and new business owners make. It is so easy to confuse cash with profit. You see a big number in the company bank account and think everything is great. But what if that cash is from a big bank loan? Or what if it's a huge deposit from a customer for work you haven't even started? That's not profit. On the flip side, you could have an incredibly profitable, fast-growing company that's on the verge of going bankrupt because it's running out of cash. Maybe it has to pay its suppliers in 30 days, but its customers take 90 days to pay. Profit on the income statement and cash flow are two totally different but equally vital signs of a company's health. You have to understand and analyze both. So, as we wrap up, I want to leave you with this final thought. The next time you open a company's annual report and you see that big number for total revenue, you're not going to just see a number anymore. You'll understand the complex, sophisticated principle that's working behind the scenes. You'll know that number represents the value the company created and earned during the year, not just the cash that happened to land in its bank account. And that understanding lets you ask much smarter questions. You can ask, okay, how does this revenue compare to the expenses they incurred to get it? Or what's the trend in their accounts receivable? Are they getting better or worse at collecting their cash? This principle, you see, isn't just some rule you have to memorize. It's the key that unlocks a truly deep and insightful analysis of any business.